Imagine waking up one morning to check your portfolio, only to discover that a single investment decision you made 4 years ago just changed the rest of your life. Your account balance is 7 figures higher. Your phone vibrates with alerts from your bank confirming transfers that could pay off your parents' mortgage, fund your children's education, and secure your retirement 3 decades early. No lottery, no miracle, just the quiet power of long-term intelligent investing, the kind the world's wealthiest have mastered while most people still chase quick profits. In this documentary, we're diving into 5 powerful rules for successful stock investing. Rules the legendary investors don't want the average person to fully understand. Why? Because if everyone understood them, the gap between the rich and the poor would close faster than Wall Street could pull the plug. Today, you're about to learn what most retail traders never learn in their lifetime. How the elite treat stock investing not like gambling, but like controlled warfare. Watch till the end, subscribe to Blood and Fortune, and drop your thoughts in the comments because this video will reshape the way you view money forever. Let's start with a truth few people realize. The stock market isn't designed to make you rich quickly. It's designed to transfer wealth from the impatient to the patient. Sounds poetic? Warren Buffett, arguably the most successful investor of all time, phrased it as, "The stock market is a device for transferring money from the impatient to the patient." This isn't motivational talk, it's mathematics. And here's what they never told you. When you buy a stock, you're not buying a number on a screen. You're buying a piece of a living, breathing business. A machine designed to generate cash every second. Corporate CEOs don't care about your panic-selling moments. They care about scaling, surviving recessions, adapting, and pushing forward. If the company you invest in continues growing its earnings, increasing market share, expanding globally, then the stock price will eventually follow. It must. That is rule number 1. Invest in companies, not stock prices. The average investor checks charts, listens to influencers, follows hype. The wealthy read financial statements, analyze cash flow, study competitive advantages, and the history of market downturns to identify future resilience. Humans react to price. Wealth reacts to value. Now, here's what almost no YouTube finance creator explains clearly. Your returns don't depend on how smart you are today. They depend on whether your decisions allow time to work in your favor. Imagine planting a seed. Your intelligence doesn't accelerate its growth. Only time and consistency do. It's the same with compounding. Albert Einstein called compound interest the eighth wonder of the world. And yet, more than 70% of investors destroy its magic by constantly entering and exiting trades, trying to beat the market, emotionally reacting to news headlines. Most people never realize this. The average investor loses 1 to 3% annually simply because of emotional decision-making, while long-term investors often outperform by doing less. Rule number 2. Master your emotions before you master any investment strategy. During the 2008 financial crisis, market indexes fell by over 50%. Those who sold at the bottom locked in catastrophic losses. Those who held their positions saw the same portfolio quadruple over the next decade. But here's the twist. Many of the investors who went broke believed they had strong strategies. They understood markets technically. What they didn't understand was their own psychology. They didn't know that once fear takes hold, logic dies. This is why the truly wealthy aren't obsessed with stock prices. They're obsessed with narratives, cycles, and capital flow. While average investors ask, "Is this stock going up?" Elite investors ask, "How does this business position itself in future economic cycles? Is it essential? Will the world still need it 10 years from now?" Don't forget, during every recession, people sell their stock in panic, but they don't stop consuming essential goods. They don't stop buying medicine, energy, technology, or food. In other words, investing isn't just about what grows, it's about what survives. The wealthiest investors don't predict the future. They identify what will remain necessary, even under attack. And here's something very rarely discussed. Wall Street analysts are paid based on performance this quarter. The world's richest investors think in decades. That's why they outperform. Rule number 3. Stop thinking like a trader, start thinking like an economic historian. Learn from past crashes, wars, inflation cycles, and technological shifts. When you understand history, you don't panic at volatility, you profit from it. Before we move to the next rule, Here's a strategy that has made millionaires quietly without attention. Dollar cost averaging into fundamentally strong companies regardless of market conditions, while reinvesting dividends and never interrupting compounding unless fundamentals change. That's the secret behind many hidden millionaires. No hype, no luck, just time, consistency, and conviction. But we're only getting started. In the next section, I'll reveal the strategic blueprint used by high net worth portfolios, the golden ratio they use to protect against crashes, how they anticipate black swan events before they happen, and the exact rule that helps them exit before bubbles burst. And trust me, it's not what you've heard online. Stay locked in. What comes next is the difference between a surviving investor and a dominating investor. Comment your investing experience so far. Have you ever panic sold at a loss? Now, let's dive into paragraph 2. Now, let's discuss rule number 4, build an anti-fragile portfolio. Most people diversify by buying lots of different stocks. The wealthy diversify by buying different asset classes that react differently under stress. They don't just own stocks. They own real estate, commodities like gold, government bonds, and even art. This isn't just about spreading risk. It's about creating a system that gets stronger from chaos. When stocks crash, their bonds might go up. When inflation hits, their real estate and gold act as a shield. It's like building a ship with multiple watertight compartments. If one floods, the others keep the ship afloat. The average investor is sailing a raft. A single big wave, like a recession or a market correction, can sink their entire savings. The wealthy command an aircraft carrier. They build their portfolios to withstand and even benefit from unforeseen events. This is why you must think beyond just stocks. Ask yourself, if the stock market were to close for 5 years, would your financial life survive? If the answer is no, your portfolio is too fragile. You need to incorporate assets that zig when your stocks sag. This isn't about being pessimistic. It's about being a realist in a world full of unpredictable events. Which brings us to the fifth and perhaps most crucial rule. Know your exit strategy before you even enter. The average investor buys a stock hoping it goes up. They have no plan for when to sell. They sell either out of fear when it drops or out of greed when it rises too fast. The elite, however, define their exit conditions the moment they buy. They have a clear thesis. For example, I am buying this company because it's pioneering a new technology and has zero debt. I will sell it if its debt-to-equity ratio exceeds 0.5 or if a competitor develops a superior technology. Notice the exit isn't based on the stock price. It's based on the fundamental health of the business. They treat their investments like a strategic military campaign. They know their objective, they know their supply lines, and most importantly, they know their retreat conditions. Without an exit strategy, you are not investing. You are gambling on hope. You're letting your emotions dictate your financial future. And as we've already established, that is a losing game. The wealthy remove emotion from the equation by replacing it with a predefined system. So let's recap the 5 rules of the wealthy. 1. Invest in businesses, not in stock tickers. Understand what you own. 2. Master your own psychology. Your emotions are your greatest enemy. 3. Think like an economic historian. Use the past to navigate the future. 4. Build an anti-fragile portfolio. Survive and thrive through chaos. And 5. Define your exit strategy before you invest a single dollar. These rules aren't complicated, but they require discipline, patience, and a shift in mindset. They require you to stop thinking about getting rich quick and start thinking about building wealth methodically. This is the great secret that separates the top 1% from everyone else. It's not about having access to secret information. It's about applying timeless principles with unwavering consistency. The market is a battlefield, and now you have the rules of engagement used by its greatest generals. Use them wisely. Let's start with a bombshell. Most investment funds actually fail to beat the market. Yet, the top 1% consistently outperform, and they do it with one key advantage: controlled asymmetry. What's that? It means they never risk a huge chunk of their money on something uncertain. Instead, they position themselves so that when they're right, the potential reward is massive compared to their limited risk. This brings us to rule number 4. Always structure your investments so that your potential loss is something you can live with, but your potential gain is life-changing. This is exactly how the wealthy survived the dot-com crash, the 2008 housing crisis, and the COVID market dip. While everyday investors were panic selling, the rich were rebalancing and strategically doubling down. But let's be clear, this isn't just reckless buying. It's calculated. They buy undervalued assets based on historical data, real value, and how resilient a sector is. You've heard the phrase, be greedy when others are fearful, right? The truth is, they only get greedy when the numbers make sense, not just because there's chaos in the market. Here's a secret most YouTubers don't explain clearly. Professional investors use volatility as a green light to get in, not a red light to get out. While about 75% of people sell when prices drop, the pros often start buying. Why? Because they follow specific portfolio allocation models. You might know the old 60-40 rule, 60% in stocks, 40% in bonds. But that's outdated. Today's elite investors use customized models like the 70/20/10 strategy. That's 70% in stable, long-term growth companies, 20% in protective assets like bonds, gold, and cash, and 10% in high-risk, high-growth areas like AI, biotech, or emerging markets. Why this structure? Because they understand the market moves in cycles. And here's the real kicker. The strength of your portfolio isn't about how high it goes in good times. It's about how well it holds up when a storm hits. That 20% cash reserve, that's their secret weapon. When everyone else is forced to sell at a loss, they have the cash to buy amazing assets at a discount. That isn't luck, it's planned domination. Which leads to rule number 5. Never invest all your money at once. Build strategic cash reserves specifically to take advantage of market drops driven by fear. Let's dig a little deeper. Think about the last 5 major market crashes: the tech bust in 2000, the 2008 financial crisis, the 2011 debt crisis, the 2020 COVID collapse, and the 2022 inflation shock. The average investor's reaction was the same every time: denial, then panic, then selling, and finally, regret. But the elite investor's pattern is the complete opposite. It goes anticipation, observation, careful entry, more buying, and then an exponential rebound. So how do they anticipate these things? They track big-picture economic signals, interest rates, unemployment numbers, commodity prices, and treasury yields. They're not trying to predict the future, they're preparing for it. This is rule number 6, an unofficial but crucial one. Stop staring at stock charts and start paying attention to the economy's rhythm. When you see interest rates rising fast, you know cheap money is disappearing, which usually means real estate and growth stocks will take a hit. When inflation is high and cash is losing its value, companies that own tangible assets tend to do well. When a new technology gets government support, that sector often surges. The wealthy follow this rhythm, not their gut feelings. They play chess, not slots. Now, let me expose a closely guarded secret. Most millionaire investors don't actively trade day to day. They accumulate wealth. They use strategies like dollar-cost averaging and dividend reinvestment programs to slowly build their fortunes over 5 to 20 years. You hear them say buy and hold, but they don't explain how they decide when to sell. They don't sell because the price drops. They sell when the fundamental reasons for owning the company have changed, or when they've hit a preset portfolio goal. And here's a psychological trick they use: force patience. They set rules for themselves, like, I will not sell this stock for at least 7 years unless the company's earnings decline for 4 straight quarters. This simple rule eliminates panic. You can't make an emotional decision if your own rules don't let you. They treat investing like a military campaign. Execute the plan, don't fight the battle on emotion. And this brings us to an incredibly powerful idea: anti-fragile investing. This concept suggests that some investments actually get stronger during chaos. Think about insurance companies during a disaster, or cybersecurity firms during a major hack. In 2020, video conferencing stocks went through the roof because the world went into lockdown. Smart investors didn't predict a pandemic. They just built a portfolio that included sectors that could benefit from what-if chaos scenarios. So, ask yourself, does your portfolio thrive in disorder, or is it only built for sunny days? If your investments can't handle extreme stress, you're not really investing. You're just gambling on optimism. Before we get to the final part, I want you to burn this into your mind. There are only 2 types of successful investors. The first is the disciplined, long-term builder who quietly grows their wealth through compounding. The second is the informed opportunist who spots major shifts before they become obvious and gets in early. Both require patience. Both require deep knowledge. And both will fail without emotional control. Rule 1 of execution: build your investment identity. Listen closely. You are not a trader. You are not an investor. And you are definitely not a gambler. At least, not yet. Right now, you are a strategist in training. Your first mission is to define your investment identity, and you'll do that by answering 3 critical questions. First, what is my risk tolerance? Be brutally honest. How much money can you afford to lose without having a complete emotional breakdown? Is it $500? 5,000? 50,000? This number dictates the kinds of assets you should even be looking at. If a 10% drop in your portfolio makes you want to sell everything, you are not ready for volatile growth stocks. Second, what is my time horizon? Are you building wealth for a goal that's 5 years away, like a down payment on a house? Or are you playing the long game, planning for retirement in 20 or 30 years? A shorter time horizon demands a more conservative approach, while a longer one allows you to weather market storms and take on more risk for greater potential returns. And third, what is my cash flow capability? Can you consistently invest a set amount every single month, like clockwork? Or is your income less predictable, meaning you'll invest opportunistically when you have extra cash? The answer to this question shapes whether you should be dollar-cost averaging or saving up for strategic entries. Most people lose money in the market because they charge in with no answers to these questions. They invest randomly, driven by a friend's hot tip or a flashy headline. They mix strategies that contradict each other. But you won't. Once you have these 3 answers, you can build your core strategy. Let's break it down. If you have low capital and an inconsistent income, your game plan is simple and powerful: dollar-cost averaging into low-cost index funds. Think of ETFs that track the S&P 500 or the Nasdaq 100. You buying a slice of the entire market consistently without trying to time anything. It's the most proven path to wealth for the majority of people. Now, if you have medium capital and a steady income, you can upgrade your strategy. You'll build a blended portfolio. Keep a core of those reliable ETFs, but now you can add individual top-tier value stocks. Think of the top 20 strongest companies in the world. Then, you can dedicate a smaller portion of your portfolio to sector growth plays, targeting industries with huge potential like artificial intelligence, renewable energy, or next-gen healthcare. And for those with high capital and advanced knowledge, the playbook expands even further. You're not just buying and holding, you're actively managing. You're executing portfolio rotations, shifting capital between sectors as the economic cycle turns. You're building a dividend strategy for passive income. You're making strategic buy-the-dip entries during market panics. And you might even be using advanced instruments like protective puts to hedge your positions or leap options to control large blocks of stock with less capital. See the difference? It's a ladder. You start where you are, not where you want to be. That brings us to Rule 2 of execution: master your capital flow. This is a concept that separates the wealthy from everyone else. Successful investors use a 3-pocket funding system. Pocket 1 is your life stability fund. This is your emergency reserve. It contains 6 to 12 months of your essential living expenses, sitting in a high-yield savings account where you can access it instantly. This money is non-negotiable. It is never, ever invested in the market. This is your fortress wall. Pocket 2 is your growth engine. This is your investable capital, the money you've designated for building wealth. Typically, you'll allocate 50 to 70% of your available investment funds here for your long-term strategy: your ETFs, your stocks, your core holdings. Pocket 3 is your opportunity capital. This is pure, liquid cash or cash equivalents, making up 15 to 30% of your total investment pool. This money sits on the sidelines, patiently waiting. For what? For market crashes, for corrections, for those once-in-a-decade opportunities when high-quality assets go on a massive sale. The average investor fails because they only have one pocket. When a real-life crisis hits, a job loss, a medical emergency, they are forced to liquidate their investments, often at the worst possible time, selling at a loss just to survive. The wealthy, however, prepare for downturns before they happen. Their stability fund protects their life, and their opportunity fund allows them to go on the offensive when everyone else is retreating in fear. Next, Rule 3, your entry strategy. Stop buying stocks just because they're going up. Chasing green candles is the fastest way to buy high and sell low. Professionals don't do this. Instead, they use a disciplined method called systematic entry banding. It works in 3 phases. Phase 1 is to initiate a position. You identify a great company that's trading at a fair price within its normal valuation range. You don't go all in. You make a small, initial entry. You get some skin in the game. Phase 2 is for confirmed weakness. This is when that great company you identified takes a temporary hit. Maybe the whole market panics over some bad economic news, and your stock drops 10 or 15%, even though its fundamental business is still strong. This is not a time to panic sell. It's a signal to buy more. You add to your position at a discount. Phase 3 is post-event consolidation. After the panic subsides, the stock will find a new bottom and start trading sideways as volatility stabilizes. This is your chance for a final entry, completing your full position at an excellent average cost. This systematic approach removes emotion from the equation and disciplines you to buy when prices are attractive, not when they're hyped. Of course, knowing when to buy is only half the battle. You also need Rule 4. Exit intelligently. Beginners sell when they get scared. Experts sell based on a predefined checklist. You sell when the story changes. Here's when an expert considers selling a long-term holding. First, if the company's earnings decline for 4 consecutive quarters. A single bad quarter can be an anomaly. A full year of decline signals a real problem. Second, if a major industry disruption appears and the company fails to adapt its strategy. Think of Blockbuster ignoring the rise of Netflix. When you see that kind of existential threat, it's time to reevaluate. Third, when the stock's valuation gets completely out of control, exceeding its calculated intrinsic value by more than 25%. At that point, the risk of a sharp correction outweighs the potential for further gains. And finally, for more advanced investors, you sell when the risk-to-reward ratio falls below your personal threshold. The position has simply run its course. Notice what's not on that list? I got scared. The market is down today. A news anchor said a recession is coming. Those are emotional triggers, not strategic ones. And finally, Rule 5. You must adapt. The markets are not a static entity. They are a living, breathing ecosystem that constantly evolves. Your strategy must evolve with it. In your early phase, your entire focus should be on accumulation and consistency. Just keep buying, keep building that base. Your job is to grow your capital. Then, you enter the scaling phase. This happens when your portfolio has achieved significant growth, maybe a 50% return on investment over a rolling 3-year period. Now, you can start adding opportunistic plays. You can enhance your diversification across different asset classes and begin learning about sector rotation, moving your money to where the economic tailwinds are strongest. Finally, as you near your goal of wealth independence, your strategy shifts again. The focus moves from high growth to high income. You're no longer just trying to grow your nest egg. You're converting it into a cash flow machine. This is where you prioritize dividend stocks, bonds, REITs, and maybe even learn strategies like covered calls to generate a steady, reliable income from your assets. But after all these rules, all this architecture, here is the one truth that no financial coach ever tells you, because it doesn't sell courses. The single most profitable investment you will ever make is in the mastery of yourself before you ever attempt to master the markets. The market doesn't punish a lack of knowledge nearly as much as it punishes emotional ignorance. That is why 90% of people who try this fail. They know what to do, but they can't control their fear and greed long enough to do it. So here's your call to action. If this framework, this blueprint, awakens something in you today, then prove it. Subscribe to this channel right now and go down to the comments and type "I choose mastery" if you are truly serious about your financial evolution. And please, share this video with one person you know who trades emotionally. You might just save them from a lifetime of losses. Because if you apply even half of this framework, you won't just be investing. You'll be creating wealth, intentionally and systematically, no matter what storms the economy throws your way. Thanks for watching.